Let's dive into Upstart's Q1 2026 earnings presentation. This first quarter represents a critical period for Upstart, especially as we evaluate how their AI model's precision has managed loan originations and default risks amidst continued market volatility. Based on the performance data released on May 5, 2026, we will conduct a deep dive into how their proprietary algorithms are navigating financial uncertainty. We will analyze whether the company has achieved the profitability improvements the market has been anticipating. So let's start by breaking down the key metrics. Let's dive into Upstart's Q1 2026 results, which show a strong trajectory toward meeting their full-year outlook. The standout figure here is originations, reaching $3.4 billion, a massive 61% increase year-over-year. This surge indicates that their AI-driven lending platform is gaining significant traction and scaling rapidly in the credit market. Total revenue followed suit, growing 44% to $308 million, showcasing robust top-line momentum. On the profitability front, while the company reported a modest net loss of $7 million, the adjusted EBITDA tells a more compelling story, a solid $40 million profit with a 13% margin. This demonstrates that despite accounting losses, the core business model remains operationally healthy and scalable. Overall, these metrics confirm that Upstart is successfully balancing aggressive growth with disciplined operational performance. Let's take a closer look at the trajectory of Upstart's transaction volume. The chart reveals a consistent upward trend in originations from Q4 2024 through Q1 2026 without a single downturn. Notably, in the first quarter of 2026, originations reached $3.445 billion, marking a robust 61% year-over-year growth. This represents a 7.8% sequential increase from the $3.196 billion recorded in the previous quarter, indicating that the company is maintaining steady momentum. While the growth rate has moderated compared to the explosive 154% peak seen in 2025, the continuous expansion of absolute transaction volume suggests that Upstart is successfully solidifying its market dominance. Ultimately, this performance serves as strong evidence that their AI-driven platform continues to gain market trust and secure reliable volume despite macroeconomic shifts. Now, let's analyze the operational efficiency through the loan conversion funnel. Looking at the chart, both total inquiries and transaction volumes showed steep growth from Q4 24 through Q4 25, peaking at 456,000 loans in the final quarter of 2025. However, the Q1 26 data reveals an interesting shift. Loan volume decreased to 425,000, a roughly 6.8% drop quarter-over-quarter, and the conversion rate also dipped from 19.4% to 18.5%. This suggests that while market demand remains robust, the final execution stage has become more challenging, likely due to tighter underwriting standards or the impact of a high-interest rate environment. Ultimately, this indicates that the company is transitioning from aggressive expansion to a phase of focusing on asset quality and risk management. Now, let's take a closer look at the total revenue trend, a key indicator of Upstart's performance. For the first quarter of 2026, total revenue reached $308 million, marking a robust year-over-year growth of 44%. Looking at the chart, the consistent upward trajectory since Q1 2025 is quite impressive. A deep dive into the revenue mix reveals some very interesting insights. The core driver, platform and referral fees, accounted for $225 million, or approximately 73% of total revenue, while servicing and other fees saw a significant jump to $52 million from $43 million in the previous quarter. This suggests that the company is not just expanding in size but also enhancing the operational efficiency of its business model. Although the growth rate has normalized compared to the explosive 102% YoY surge seen in Q2 2025, the steady step-up in nominal revenue figures indicates a stabilizing and scaling business that will likely strengthen market confidence moving forward. Now, let's dive into Upstart's contribution profit, a critical metric for evaluating the company's core profitability and unit economics. For Q1 2026, the company reported a contribution profit of $137 million, representing a robust 34% year-over-year growth. Looking at the trend, while profit levels have slightly moderated since peaking at $147 million in Q3 2025, the overall performance remains significantly higher than the $102 million recorded a year ago. However, it is important to note the contribution margin, which has compressed from a peak of 58% in Q2 2025 to 50% this quarter. This downward trend suggests shifts in operational efficiency or cost structures during their expansion phase, and how the company stabilizes this margin will be a key factor for long-term profit sustainability. Now, let's examine the trend of net income, a critical indicator of the company's bottom-line health. Looking at the chart, the company successfully turned a profit in Q2 FY25, reaching a peak of $32 million with an 11% net margin in Q3 25. However, profitability began to decline in Q4, and it is quite concerning to see a reversal back to a net loss of $7 million in Q1 FY26. This represents a significant swing from a $19 million profit in the previous quarter to a deficit, with the net margin dropping to -2%. This shift suggests that changes in the market environment or a spike in operating expenses have immediately impacted profitability. As the solid earnings growth trend has broken and entered negative territory again, we must closely monitor the company's ability to optimize its cost structure and restore profitability in the coming quarters. Now, let's take a close look at the trend for adjusted EBITDA, which reveals Upstart's actual profit-generating power. We see a very interesting pattern here. After peaking at $71 million with a 26% margin in Q3 25, the figures have shown a downward trend for 2 consecutive quarters. Specifically, the adjusted EBITDA for Q1 26 came in at $40 million, marking a decline of over 37% from the previous quarter, with the margin also dropping sharply to 13%. This effectively brings the performance back to the levels seen a year ago in Q1 25. This suggests that external factors, such as the high interest rate environment or tightened lending standards, have created a temporary bottleneck in maintaining profitability. Whether the company can rebound and restore its margins to the 20% range will be a critical variable for future valuation. Now, let's take a close look at Upstart's reaffirmed financial outlook. For fiscal year 2026, the company is targeting a total revenue of $1.4 billion. The key takeaway here is that $1.3 billion of this is expected to come from fees, highlighting a capital-light and highly scalable business model. Furthermore, an adjusted EBITDA margin of 21% signals a robust path toward profitability. Looking at the 3-year target, the projected 35% compound annual growth rate through 2028 is an incredibly ambitious figure that underscores their growth potential. By aiming for a 25% margin by 2028, the company is demonstrating its clear strategy to achieve significant operating leverage as it scales. In summary, this guidance reflects management's strong confidence in delivering both aggressive top-line growth and disciplined bottom-line expansion over the coming years. Let's focus on a critical metric here, the inaccuracy gap. This measures how far a model's predictions deviate from perfection, where 0% represents a flawless prediction, meaning lower is significantly better. Look at the trend. Our AI model started at 92.3% in Q2 2018 and is projected to drop to 87.4% by Q1 2026. In stark contrast, the traditional credit model remains stagnant at 95.4%. This clear divergence demonstrates that our AI is meaningfully more accurate at evaluating borrower risk than legacy systems. Upstart has already closed 12.6% of the distance to a perfect model, while the traditional benchmark has only managed a 4.6% improvement. The key takeaway is the runway ahead, with 87.4% of the accuracy opportunity still remaining, we expect years of continuous modeling improvements to drive further competitive advantages. This sustained trajectory of precision will be the primary engine for long-term outperformance in the credit market. Let's take a look at the trend of Upstart's AI automation rate, a core pillar of its competitive advantage. This chart illustrates the percentage of loans processed entirely by AI without any human intervention. Starting at 69% in Q4 2019, the automation rate is projected to reach a remarkable 91% by Q1 2026. While there was a temporary dip due to market volatility during the early pandemic in 2020, the consistent upward trajectory past the 80% and 90% milestones highlights their continuous technological advancement. Reaching 91% automation means the company can drastically reduce labor costs while providing customers with near-instant loan approvals. This clearly demonstrates that Upstart is leveraging its AI to achieve significant operating leverage and build a highly scalable, tech-driven financial ecosystem. Now, let's break down the math behind Upstart's ambitious target for Q1 2026. Looking at Step 1, out of 539,000 accepted rate offers, 77% or 417,000 applications are funneled into the automatic approval track. The most critical metric here is the conversion efficiency. Automated approvals convert at a rate of approximately 9 out of 10, which is 3 times higher than the 3 out of 10 conversion rate for manual reviews. This efficiency gap is the primary driver behind the final projection. A staggering 91% of the total 425,000 funded loans will be processed with zero human intervention. For investors, this signifies a massive leap in operating leverage and scalability, as the platform demonstrates its ability to drive higher loan volumes while significantly reducing friction and operational costs. Let's take a look at the trend in Upstart's unsecured personal loan originations. We are seeing a very compelling set of data here. As shown in the chart, originations hit the $3.0 billion mark in Q1 2026, a significant leap from approximately $2.0 billion in Q1 2025. This represents a robust 50% year-over-year growth, signaling a powerful expansion phase. Furthermore, the number of loans exceeded 410,000, confirming that this growth is driven by substantial transaction volume. In a fluctuating interest rate environment, this performance suggests that Upstart's AI-driven underwriting is effectively capturing market demand while maintaining a competitive edge. Ultimately, these figures underscore the company's strengthening dominance in the credit market and serve as a primary catalyst for its financial momentum this quarter. Now, let's dive into a very interesting dataset that reveals a qualitative shift in the unsecured personal loan market. In Q1 26, total originations reached approximately $3.04 billion, maintaining a steady upward trend. The key metric to focus on here is the quality of the loans. If you look at the chart, the superprime segment, those with FICO scores of 720 or higher, surged to 33% of total originations, up 6 percentage points from 27% in the previous quarter, totaling $993 million. What's particularly telling is that while the total number of loans actually decreased by about 33,000 compared to Q4 25, the overall dollar volume increased. This indicates a rapid portfolio rebalancing toward high-credit, high-value borrowers. Ultimately, these figures prove a successful strategy of maximizing profitability while strictly managing risk amid market uncertainty. Now, let's take a close look at the auto originations trend, which presents some very compelling data. In the first quarter of 2026, originations reached $263 million, representing a robust 32% sequential increase from the $200 million recorded in the previous quarter. Even more impressive is the year-over-year performance. This figure is approximately 4 times higher than the $65 million seen in Q1 2025. This rapid growth is also reflected in the loan volume, which surged from 2,073 to 12,202 loans over the same period. These results serve as a key indicator that Upstart's AI-driven lending model is successfully scaling and proving its strong competitiveness within the auto finance market. Let's take a close look at the home originations chart, which reveals a very compelling growth trajectory. In Q1 26, originations reached $143 million, marking an explosive expansion for the segment. This represents an approximate 3.5-fold increase compared to $41 million in Q1 25, and a solid sequential growth of 16% from the previous quarter. If you look at the loan count at the bottom, it has scaled from 453 in Q4 24 to 2,300 in Q1 26, indicating a rapid gain in market share beyond just dollar volume. The fact that both loan volume and total committed amounts are rising in tandem suggests that this business model has successfully gained traction. This trend clearly positions the home sector as a powerful long-term growth driver for the company's overall revenue mix. Let's analyze the Upstart Macro Index, UMI, which estimates the impact of the macroeconomy on actual credit losses for unsecured personal loans. Looking at the chart, the index peaked above 1.6 in early 2024 but has since trended downward, reaching 1.38 as of March. While this remains higher than the lows seen immediately following the pandemic, the recent stabilization suggests that macroeconomic volatility is moderating. This data indicates that consumer credit risk is now staying within the predictable range observed since late 2025, providing a more stable outlook for the credit market. Overall, the macro risk environment appears to be normalizing within a manageable threshold. Let's take a close look at this chart tracking our credit performance since the first quarter of 2023. A standout metric here is that every single personal loan cohort has outperformed U.S. Treasuries by at least 385 basis points. The teal dots represent expected cash flows, while the gray dots indicate the 2-year Treasury yield. Notice the consistently wide gap between them. According to the data on the right, an equal investment across all cohorts would yield a substantial 6.5% annualized premium over the 2-year Treasury. While the upside and downside ranges widen for the 2025 projections to account for future variables, the expected returns remain significantly higher than the benchmark. This trend clearly demonstrates that the underwriting model is successfully delivering robust risk-adjusted returns and significant alpha, even amidst shifting interest rate environments. Now, let's examine the trend of Upstart's co-investments in committed capital partnerships. A very interesting metric emerges here, the capital co-invested, representing the cumulative outstanding amount Upstart has invested to share risk, is projected to more than double from $433 million in Q4 2024 to $1.044 billion by Q1 2026. What's particularly impressive is that starting from Q1 2025, the current assessed value begins to consistently exceed the actual capital invested. By Q1 2026, the assessed value is expected to reach $1.167 billion, with a maximum potential upside of $2.17 billion depending on loan performance. This provides clear evidence that Upstart has strong confidence in its AI models and is effectively aligning interests with its capital partners to bolster platform credibility. Ultimately, this expanding scale of co-investment serves as a positive signal for the company's future profitability and market expansion. Let's analyze the trend of loans held by Upstart on their balance sheet. Total loan holdings peaked at $1,230 million in Q3 25 and have since stabilized at $1,014 million as of Q1 26. The most critical metric here is the R&D loans segment. Accounting for $631 million, roughly 62% of the total in Q1 26. This indicates that the company is strategically retaining loans to test and evaluate AI models for emerging products like auto and home. Meanwhile, securitized loans have steadily declined from $103 million to $45 million, showing a reduced exposure to legacy asset-backed securities. In summary, Upstart is shifting its balance sheet focus toward active R&D to enhance model accuracy, which will be a key driver for its expansion into new credit verticals. Now, let's analyze a critical slide that highlights Upstart's funding structure and its strategic risk management. Looking at the chart, the total loans outstanding show a robust upward trajectory, growing from approximately $12 billion in Q4 2024 to over $16.3 billion by Q1 2026. The key takeaway here is the remarkably low proportion of loans held on Upstart's own balance sheet. Despite the significant expansion in total volume, the percentage of loans held remains consistently stable within the 6% to 8% range. Notably, after peaking at 8.7% in Q3 2025, this metric retreated to 6.2% by Q1 2026. This trend confirms that the vast majority of loans are funded by third-party partners, underscoring Upstart's success in maintaining a capital-light platform model. By offloading the majority of credit risk to external investors, the company continues to demonstrate its scalability and operational resilience in the current lending environment.